Okay, so we're going to be talking now about answering the final question, which is step 3 of the 3 steps to heaven. And that is basically, do we have a trend, yes or no? Now, where does that fit in? Well, it really is about understanding where we are at in the life cycle of the market, as we've discussed before, just to recap that. So it's not only the question, do we have a trend? It's also potentially, do we have a range? So it doesn't really matter what the answer to the question is, as long as we know what it is so that we can say where we are at in terms of that final question, either in a trend or in a range. Remember, those are two mutually exclusive market conditions. And yes, we do get sub-conditions, but you need to start there. All right, so what we're also going to be talking about today briefly is understanding at what point we can assume we've got a transition between the one or the other. These transitional points are obviously very, very important. Okay, so going down again to the 3 steps, let me go to this chart here, where we've already been through step 1 and step 2. If you haven't familiarized yourself with how to answer these questions, where does each wave begin and end, firstly. Secondly, being able to classify the waves as phase 1, phase 2 waves. If you're not familiar with that, please make sure you go and do those first, because they are critical building blocks, or obviously steps that need to be taken before you can get to the final step, which is answering this question from a price action point of view: do I have a trend? Right, so remember that in order to be able to answer that question, we need to understand the definition of a trend as well in price action terms, and I'm going to get to that in a second. But at a practical level as well, we look for quite simple, a simple sign that a trend has either started or come to an end. And you'll see here that we look for a breakout from the range to identify the start of a trend, and a breakdown in the sequentiality of cyclicity for the end of a trend. And obviously, between those two moments, we assume we have a trend. And that allows us to do quite a few things, as you will see in our training. But let's first of all just briefly discuss the definition of a trend in price action terms. Now, you'll remember that we've got 2 elements of price action. The one is cyclicity and the other is support and resistance. So we have, in fact, got a definition for both of those. Now, that might look overly complicated, but in actual fact, it's really one and the same thing. They're almost like 2 sides of the same coin, as I've mentioned before. So in terms of cyclicity, we understand that a bullish trend is defined as an intact sequence of bullish phase 1 waves and bearish phase 2 waves. And here you can see how important it is to understand what a phase 1 and a phase 2 wave is, and of course, conversely, for bearish. Now, in terms of support and resistance, it's a consistent breaking of resistance and respecting of support for a bullish trend, and conversely for bearish, a consistent breaking of support and respecting of resistance. Now, if you were just to picture in your mind's eye, if we just go back to cyclicity, if you picture a sequence of phase 1 waves, remember a phase 1 wave, in a bullish phase 1 wave, is a bullish wave that breaks and closes above the previous wave's high, followed by a phase 2 wave, which would fail to break and close below the previous wave's low, followed by another bullish phase 1 wave, which breaks and closes above the previous wave high. You can see in your mind's eye that what you would have, therefore, is a consistent breaking of resistance and respecting of support. So they are effectively one and the same. The definition of a bullish trend in terms of cyclicity and support and resistance, really, you can see it is one and the same, just using the different elements. And that is very helpful in certainly in analyzing charts generally, and not just in terms of answering this question either, do we have a trend, yes or no, but in other areas as well. Okay, so coming back to the practical aspect of this, we remember that we will identify the start of a trend as a breakout from the existing range. Now, what we're doing there effectively is we're using the definition of a trend in terms of support and resistance to allow us to identify the start of a trend. Why is that? Well, remember that here we have the definition, let's assume a bullish trend. that we've got a consistent breaking of resistance and respecting of support. Well, consistent implies two or more, certainly. You can't say that you've been consistent with something if you've only done it once. You can only start maybe saying that you're consistent with something if you've done it twice, and obviously preferably more than that. But in order to get to two breaks of resistance in this case, you need to get past one. You need to have the first break of resistance in order to get to the second one, clearly. The question then for us is, well, which resistance level would we be looking at for that first break? And this is a key question because it's not just any break of resistance, it needs to be the top of the range. And obviously, I'm sure you could picture it for the opposite for bearish trends would be the bottom of the range and a break below support. But we need to identify, therefore, the upper and lower boundaries of the range in order to be able to do that. And that is, in fact, the subject of our next training session. But for now, I just need you to assume that we know, probabilistically, of course, where the top of the range and the bottom of the range are. That would be the first breakout. Once we get a breakout from the range, we can say, right, we've got a potential trend. And that is also identified, therefore, as the start of a trend. If I just go back to our diagram up here, that is where we transition from range, which is number one, to number two, which is start of trend. Now, start of trend is, in fact, potential trend. If we have a potential trend, it means we don't yet have an established trend. Now, an established trend is one that conforms fully to those definitions, which would imply that we would need to have a second cycle outside of the range. But just for the start of the trend, we need to be able to identify the potential start of a trend because we can actually start using that immediately. And for that, we identify the breakout of the range so that we can then assume that we've at least got a potential trend. Right, so that's the start of a trend. What about the end? Well, as we mentioned before, and that would, of course, be going either, well, assuming that we get an established trend and then transitioning from established trend back to ranging, either that, or if we only had a potential trend and it did not become an established trend and therefore went back into a range, that would mean that we effectively had a false breakout. And we'll be looking at that in future trading as well. So you can go from potential trend straight back into range, or you can go from potential trend into established trend and then eventually back into range. Okay, so what about that transition? How can we identify when we go from trending back into ranging? And as I mentioned before, that's when we look for a breakdown in the sequentiality of cyclicity. So effectively what we have done here is we have used definition number 2 here to help us identify the start of a trend. And we're using the definition in terms of cyclicity to help us identify the end of a trend. Now, as I mentioned before, that you can actually switch those as well, but it's a lot easier and more practical just to do that. So the end of a trend then would, as I say, be represented by a breakdown in this definition, which would mean that we no longer have an intact sequence of phase 1 and phase 2 waves. So if we've got phase 1, phase 2, phase 1, phase 2, phase 1, phase 2, and then have another phase 2, that would be represent a breakdown in the sequentiality of cyclicity. And of course, there's only 2 ways we can have that breakdown, either phase 2 followed by phase 2, or phase 1 followed by phase 1. And it's at that point that we assume that we have transitioned back into a ranging market, and we would then need to be able to define our potential range. And as I said, that is actually going to be the topic for our next trading session. All right, so let's have a look at that on a chart at a practical level. Okay, so here we have a ranging market. We've got the upper boundary and the lower boundary. Remember that I'm just asking you to assume that these are the correct levels for the upper and lower boundaries of that range. It's just going to help me to illustrate the teaching point for today. All right, so at this point in time, clearly we are still inside of our range, and therefore we need to treat this as a ranging market and would never look to apply a trending strategy. The next day, you can see how the market came up and tested that resistance level. It did, in fact, go above it slightly, but that is not a breakout. That is a failed test. It's not even a false breakout. So at this point in time, we are still assuming a ranging market. However, on the close of the next day, we did have a candle closing outside of our range boundaries. And it's at that point in time where we are able to assume that we have transitioned between a range and at least a potential trend. So we're saying start of trend here, or alternatively, you'll hear me use the expression potential trend. It's not yet an established trend. All right, so it's also clearly a phase one or impulse wave. The only type of wave that can break out of a range must be, of course, a phase one or impulse wave, simply because of the definitions that we're using here. All right, so moving along, you'll notice that that continued for a while, still a phase one of a potential trend. At this point in time, you can see we actually had a non-relevant isolated high here. I'm sure you guys, depending on what strategies you're trading, you know how to use that. But still a continuation of this impulse or phase one wave until eventually we got that isolated high. And as you know, from step one of the 3 steps to heaven, that means that now that bullish phase one wave is over, and we now have an incomplete bearish phase two or retracement wave. Right, let's see what happens next. And we're not talking about strategies here at all. This is purely on answering the question, do we have a trend, yes or no? So please make sure that you don't allow yourself to get confused by that. So I just want to move that up so you can see what happens. And please ignore the additional analysis that I've got on this chart. We're just looking at just the top and the bottom of our range boundaries. All right, so you can see at this point in time, it actually came down and bounced off of this, what was resistance turned support level. And although it gave us an isolated low, it was in fact an inside bar. So I'm not yet going to put in an additional wave line, but I'm sure you guys will recall that you may want to do that, but that is strategy dependent. However, at the end of the following day, you'll notice that this low was then ringed by a higher high in this candle, even though it was not ringed by that inside bar, which means that we are now able to assume that we are into the next impulse wave, even though it has not yet proved itself as an impulse wave. Remember, phase one wave must close above the previous wave's high in order to be a confirmed phase one wave. But hopefully now you can see the practical usefulness of being able to say that we are in, even if it's only a potential trend, because the definition of a trend is an intact sequence of phase one and phase two waves. Therefore, because we know that the phase two wave is over for sure, we are able to assume that we are into the next phase one wave. That may even have happened with the inside bar, but as I said, that is strategy dependent. But at least you can see now that that bearish phase two wave is over. And because of the definition of a trend, we can assume that we're in a phase one wave. Now, it may not be a phase one wave. This might not make a higher close. And therefore, we might have a phase two, in which case this would have been a false breakout. That's the one potential outcome of the scenario. The other is that it does break and close above that previous wave's high, in which case we would go from potential trend to established trend. So hopefully you can see how that works. The next day, you'll see that the market continued to go up. And in fact, on this day, we did get a higher close, confirming that this is an established trend at that point in time. That doesn't mean it's going to carry on going. It could come to an end immediately after this. We don't know. We don't make assumptions. However, at this point in time, we can say we've moved to that point 3 on our market life cycle, where it's no longer a potential trend. We're now in an established trend. So the only thing that can happen after this is that it eventually is going to go back to a range. But for that to happen, we need to have that breakdown in sequentiality of cyclicity. All right, so, and in fact, there we had the end of that bullish impulse wave, which means that we would now be able to assume that we are in a bearish phase 2. And you'll see that it actually came back and closed inside previous waves price territory, but it is still a trend. There has not been as yet a breakdown in sequentiality of cyclicity. Now, of course, this could carry on down and close below that wave's low. And if that did happen, we would have phase one, which would indicate a breakdown in sequentiality of cyclicity and therefore the end of the trend. But until that happens, we assume that cyclicity will remain intact. These are crucial teaching points, folks, and learning points. You'll notice that at the end of that day, this low was ringed. This, of course, is step one of the 3 steps to heaven, which is defining the beginning and the ending of each of these waves. After that, we need to define if they are phase 1 or phase 2. Now, at this point in time, we can assume that we are into a phase 1 wave because this the phase 2 wave is over and the trend is not yet over. So if the trend is not yet over, our definition we assume is still intact, which means sequentiality we can assume is intact. So even though this has not closed higher than that wave high, we are assuming that this is the next phase 1 wave. And as it happens, we did get a higher close, which means that we did still have intact sequentiality of cyclicity, which means our trend is still intact. And also, of course, that is a phase 1 wave. And it's a correct definition of a phase 1 wave with a higher close. And that, of course, is step 2 of the 3 steps to heaven. This continued up. We haven't even had a non-relevant isolated high. You can see it carried on for quite some time until eventually we got that isolated high ringed as well, I do believe, which means that, and you can see that the next sort of lot of cyclicity is coming in on the right-hand side of the chart. Very much an established trend. So what we want to do now is just illustrate when that actually came to an end, which was at this point in time here. So we assumed, however, before this high was isolated, and certainly it was also ringed, before this high was ringed, we were assuming that this was going to be the next phase 1 wave until the market proved otherwise, which ultimately it did at this point in time. At the end of this day, we had a breakdown in sequentiality of cyclicity. You'll recall that this is a phase 2 wave. Even though it made a higher high, it failed. Any candle in that wave failed to close above the previous wave high, which, and this is step 2 of the 3 steps to heaven, has allowed us to identify that we've had a breakdown in sequentiality of cyclicity, which therefore means that the definition of the trend has been violated, which means that this trend is now over. And that is it, folks, from beginning to end. Breakout for the start of our trend, which leads to, first of all, a potential trend. A potential trend then, in this case, became an established trend. That established trend, then the sequentiality broke down, which means that we now assume that we are back into a range. There are 2 other possibilities I've mentioned before, but we will talk about that in a future trading session in more detail. But for now, we just call it the 3 R's. The first R is what we assume, range. We might get a resumption of that bullish trend, or in fact, we might get a reversal, which means that we get the start of a bearish trend. But in order for either a resumption or a reversal to happen, we would have exactly the same as what we've had here. We would have a breakout of our range or potential range, giving us a potential trend leading to an established trend or even a false breakout. So, and that's it. This is all there is. It's just going round and round in circles, you know, or ranging to trending, back to ranging to trending. Now and again, we'll get a false breakout. In fact, false breakouts are pretty common, and so on and so forth. Okay, so if you do have any questions, please do pop them into the comment section, and we will answer those for you.